When we zoom out, then Bitcoin has been one of the best performing assets across all asset classes. But the problem is how the price can first rally to then subsequently drop by 60, 70, 80%. So it begs the question, is there a way to potentially time the market? And this here is one of my favorite approaches. Many analysts have tried to fit the data to the historical Bitcoin price development. And the best price fit I could find is by Onchain Mind. This is a small upcoming YouTube channel where he's publishing various indicators in his premium membership and where he's also publishing this logarithmic regression. Now, the upper band of that regression is at 225k. The lower band is at 46k. We are currently still slightly above the medium value, which is at 96k. Have a look at this. This is a very commonly used indicator in traditional finance, the MACD. It measures the delta between two moving averages, and it seems like over time the momentum for Bitcoin is going down. In other words, there are diminishing returns, and it does make sense to take profit earlier and earlier from one bull cycle to the next. So here is that MACD. Have a look at how the tops tend to come lower and lower. And maybe this line is even understating how quickly this is declining. And maybe, at least in terms of momentum, we've already seen Bitcoin's price peak at 72k and the additional performance to 125k, which is much slower compared to prior bull markets. Actually, when we look at that price peak of Bitcoin, 72k, we have seen that since then, Bitcoin tended to underperform technology stocks. So this is Bitcoin relative to QQQ, a Nasdaq 100 ETF. So really, all of the gains from 72k to our 125k had just been made because risk-on assets in general appreciated. But over the last 1.5 years or so, Bitcoin's performance hasn't been as good as it should be given its volatility. Now, it is to be expected that as an asset class grows, as the market cap gets larger and larger, that in percent, relatively speaking, the growth should slow down. The returns should slow down. The problem that I have, though, is that the decline of the returns is much higher than most people anticipated. The momentum is simply coming down fast. This is the pi cycle oscillator. So this is a delta of two moving averages that historically gave us very nice top signals as well. It also gave us good bottom signals. But this time, it seems like unless we suddenly see a surprise rally to 200 or 250k, we are topping out much earlier than historical momentum would suggest. If you're getting value out of this content so far, then feel free to give this a like. You can also subscribe because I publish videos regularly. Of course, any support is very much appreciated. It will help the channel grow. Have a look at those technical pricing levels. Again, an indicator published by Onchain Mind. We tended to be above all three of those moving averages during a bull market. Once we crossed the red of those moving averages, the slowest one, we entered a bear market. How much further can we fall and still be in a potential bull market? The answer is we could fall roughly to $80,000. Once we go below that level, it's probably time to manage risk very aggressively, to open some hedging positions. The indicator would have led us to sell at around 47k when we then went down all the way to 16k. We did bounce just recently in April of this year. And so let's see how we will continue. Here's the Puel multiple. This is an indicator showing us the mining rewards. Whenever miners are particularly profitable, the market tends to be heated. Whenever miners are not profitable at all when they're losing, that's when the selling pressure has subsided. Unfortunately, we are currently not at low levels, so we are not cheap, but we are also not extremely heated. Check this out. This is the short-term holder cost basis. We can fall below that during a bull market, but not by much, by maybe one standard deviation, and that's when we should get back into the market. We're not at that bottom right now. For me, the main question is always, when we are currently coming down, will this cause for the price decline suddenly go away? I think the reason why we are going down is because long-term holders are selling. The people that bought Bitcoin in the early days for just a few $100s, they are now selling. And the problem is they continue to sell. And that's the big issue. This is a free chart by checkonchain.com. Just search for this in Google, long-term holder supply, net position change. And whenever they are selling, we tend to be at the end of a bull market. Whenever they are buying, we have at least a medium-term bottom. In other words, we should be buying with the long-term holders, we should be selling with the long-term holders. Unfortunately, they are currently selling, and they didn't stop at all. They just continue and put a lot of pressure on the price development of Bitcoin. That's why I'm not bullish. I do not like that the long-term holders continue to offload, because that's really what's causing all of that trouble. If we want to time the market to a degree, if we don't just want to buy and hold, and looking at the general trading range makes sense, looking at the reason for a price decline makes sense, and being cautious when the smart money is exiting the market probably makes sense as well. Now, this whole game can be as complex or as simple as we want. We can just dollar cost average into the market, just bet on long-term adoption, bet on long-term devaluation of money, and we are fine. We don't necessarily have to time the market. Alternatively, we can make it very complex, as in we try to follow every single piece of news. We try to get an edge by being more informed than the average market participant. I think the best is a middle ground. Trying to still time the market, but not just based on guesswork, based on mathematical approaches that used to work pretty well in the past. And so this is my favorite approach. It's following a technical indicator, the moving average, that historically worked the best. What we see over here, that's the 44-day simple moving average. And the strategy is very straightforward. We go long, we bet on rising prices whenever we are above that moving average, and we bet on falling prices whenever we are below that moving average. Now, I've backtested all moving averages from the 2-day to the 200-day, and the 44-day is one of the best. And historically, this worked very well. Will it work in the future? Who knows? But at least over the last 10 years, it performed much better compared to just buying and holding. Buying and holding is the line here in white. Every horizontal line here, by the way, that's a 10x return. So this performance is more than 100x better than just buying and holding Bitcoin. Here's the same performance measured in BTC. And so that's then the potential alternative to just dollar cost averaging into Bitcoin, trying to ride the market. Now you can simply trade this yourself, right? You can just buy and sell whenever you're above or below the 44-day simple moving average. Or if you wanted to, you can also allocate towards that strategy directly. So that's part of the premium membership of this channel. The link is down below. It's thebitcoinstrader.com. A link to premium pops up here on the screen. It will lead you to the website. Thanks again for watching, and see you next time. Cheers.